Hello, everyone. Happy Saturday. I hope you guys are having a fantastic week so far, or have had a great week and now are heading into a fantastic weekend. Today, I wanted to talk about something really important, and that is two main types of investing, and that is active versus passive investing. And so, the first thing that we're going to do today is we're going to talk about what is the difference between active and passive investing. So we'll start by backing up and just kind of breaking it down to a really simple component. Active investing is basically getting involved in some of the nuts and bolts. That includes underwriting, purchasing, building a team, performing asset management, managing your own property, determining when to sell, and getting involved in basically every single aspect of the property. Maybe delegating out some like property management, but generally being there for the entire life cycle of the investment from beginning and even before the beginning and prepping up you and your team to get ready to buy the property to the end when you're actually ready to sell and getting it all liquidated. So in being active investing, let's go there first. I want to talk a little bit about what active investing is. And active investing is more involved in single families. It can be very time consuming, and it's usually done in the smaller scale space. So when people are starting off and wanting to learn how to do this themselves, generally, if you're more hands-on and really want to like kind of discover how to do this all and how everything works, and you have lots of questions and you've got lots of time, and you have maybe a little bit of money, but not a lot of knowledge, then single family and being active is always the best way to go because it helps get you the knowledge to help move you off into different avenues and be even more passive or more active no matter what you do. So that is one of the pros, is that there's a lower entry point as well. It can be more profitable by doing BRRRRs, because when you do BRRRRs, you can get in your local neighborhood and then eventually end up finding an investment or a property where you could have essentially zero money in the deal after you've completed your rehab and refinanced out all of your original seed funds plus the rehab themselves. There's also more advantages to doing kind of more active investing, including inventory access, because when you're working in the small multifamily and single family space, it's a lot easier to buy property and also to sell them because there's more buyers and sellers doing single family homes. If you just look around your neighborhood, you can tell that there's a whole lot of individual single family homes as opposed to one apartment building in the block, right? And the other thing is that is worth saying is that you have full control. So yes, while you have the full responsibility of having the entire asset for the whole life cycle of the investment span, you also have the privilege of being able to control it, which means you can refinance, you can rehab it, you can put loans on it, you can split the equity up and partner up with people, you can live in it, you can add on to it. And there's a whole bunch of other things that you can do too that's really interesting. The cons of investing actively is that there's a higher time and energy commitment up front. It can also be pretty risky. And usually, when you're very active, it can be hard to scale, especially when you're first starting out and you're working in the single family spaces, because you got to spend all this time and energy and inertia buying one property right at the beginning. And it takes a lot of time and energy to get that going. Okay. So now let's talk a little bit about why and how passive investing is different. Passive investing is different. You basically have uh, and when I refer to passive investing, I'm generally referring to syndications. So usually it's done on the commercial real estate side, which is multifamily or like self-storage units, or retail spaces. Lots of different types of sectors here, but I'm generally referring to multifamily, which is where I have most of my experience in. In passive investing, you have clear and well-defined teams from the beginning, and there's usually two groups of people. There are general partners and then there's limited partners. The general partners are actually the active part of the team. So there's active partners and then there's passive partners that are inside of a team that makes a syndication run in a big multifamily complex, okay? And in order to describe that a little bit better, I'm going to go ahead and give a visual because I'm kind of a visual guy. So I'm going to see if I can share my screen here, and I want to show you what it is that I am referring to. All right. So here is generally, if this is an image from my book, but in general, this is what it looks like when you're doing a syndication. Like I said, you have limited partners, which are LPs, and then you have GP, and everyone's got a role. When you're a passive investor, a limited partner comes in and brings cash or liquid funds, and they make up a large part of the entire apartment's equity, okay? The other piece is the general partners. They get to participate in equity without bringing any cash to the table, but they have experience. They know how to find the property, they do the underwriting, the business plan, they arrange for the loan, they operate the property, including talking with the property manager, making sure all those clogged toilets are cleaned out and everything is running smoothly. And they do the accounting, taxes, and send that off to all of their equity partners here on the limited side. And then they're responsible for the sale and disposition, okay? So all of the sweat equity is on this side. So in a passive type investment, there's active partners and passive partners. And to be honest with you, if I could be passive all the time, I would love to be up here in this. It's just that my cash, I don't have the cash that I personally would want to have in order to make the right amount of income every month yet. Eventually, we're getting there, but that's where we're at right now. And so just to make sure that this is kind of driven home, you have limited partners, general partners, and they come together and they make up all of the equity, right? So $1 contributed in equity, 80 cents of that ends up going into the whatever the down payment is, plus rehabs, closing costs, acquisition fees, everything that goes in there, that cash target, that is your representative equity in the entire property. Don't worry about the commercial debt. That has no equity ownership. It's just debt. So every dollar that a LP puts in, 80 cents of it on a dollar per dollar basis goes in, and you are an equity owner on a dollar per dollar basis based off 80 cents, because 20 of that goes to the general partner for doing all of the due diligence and finding everything there. Okay. So just wanted to make sure that was clear. That's how syndications work. Now let's talk a little bit about why it is different, okay? Because in passive investments, okay, you have well-defined rules. When you're a limited partner, you have equity stake just like you would on the active side, except you're not really doing too much of anything. You're basically putting your cash in and letting it work, because you're partnering with people who have the roles, or they're defined, and they have the activity and the responsibility to operate and manage that money for you in the investment in the correct way. So in essence, you end up getting equity and you end up getting returns as if you were holding real estate, one slice of an apartment building instead of one whole house, right? Which may or may not be good or easy for you to conceptualize. You get all of the ownership rights that you would have on the active side, but you get it easier on the passive side because someone else is operating it for you. You get better tax benefits because of the economies of scale. In general, you're able to save on expenses a little bit more, and you're going to be able to tap into some experts into the market by doing it this way. Some cons by going into an apartment syndication or some sort of a self-storage syndication is that there's less control. Once you put the money in, you're basically committed to whatever it is that your partners are going to decide to do. Yes, you're entitled to having first crack at all the returns that come in. That's something that we put in place to make sure that the investors who put cash in are protected and they're getting what their objective is. So they get paid first, usually in the form of what's called a preferred return, or PREF. But generally, there's a loss of control. So you'd have arguably less returns than if you were to do single families yourself. If you went in and tried to do BRRRRs and got yourself some insane infinite rates of return by pulling out all of your original seed capital, that's absolutely possible to do on the active side. But on the passive side, it's a little bit more difficult to do. I've seen some excellent returns because of some excellent choices that operators make. But in general, if you have if you have less time and more money, then this is usually the best case scenario for you, is to partner up with people, go into an apartment syndication, and work on the passive side. Okay, so now finally, we're going to talk about what is right for you. That's actually one of the most important things, and things that I get asked all the time. It's dependent on a lot of different things, okay? But generally, it depends on risk factor. It depends on your readiness and your level of knowledge, your level of time availability, and your capital availability, how much money you have to spend, okay? So all these things kind of feed together, and it depends on your personality, it depends on your temperament, your risk profile, all of these different things, right? And usually the best way to do that would be to talk with an actual investor who's done a lot of this before, because they've been on both the active and the passive side. And like I said, I would love to be more and more on the passive side, but in order to pay the bills right now while we're building up the passive income, we have to be more on the active side and really add value by doing sweat equity and working really hard for our investors. So if you want to know more about whether or not active or passive investing is for you, please let us know. There should be a link either in the description of wherever you're watching this, if it's on LinkedIn or YouTube or Facebook. There should be a link somewhere in there, or link to our company profile, where you'll be able to find out more about how to get in touch with us so that we can talk through all of this, okay? So hopefully that was useful for you, and I wish you guys a fantastic weekend if you're watching this on Saturday, the 26th of June in 2021. If not, if you're watching this in the future, please don't hesitate to reach out to us. We really want to help. We want to be there for you, and we want to help inspire people, especially married couples, to leave their full-time jobs by setting up passive income streams on the side that they can depend on instead of their jobs and their W-2s and their professional 1099s, their self-employment. So hopefully that was useful. Please reach out if you have any questions, and we wish you a fantastic weekend from here at Elevate Equity. This is Derek. We'll talk to you later. Take care, everyone.